All right, we begin right here in Nigeria. Monetary Policy Committee of the Central Bank raised its monetary policy rate, benchmark rate, 50 basis points to 18% at its just concluded meeting, March 2023. The governor of the Central Bank of Nigeria, Gordon Mefele, disclosed this while addressing journalists. He also claimed the decision was made due to rising prices, exchange rate pressure, and expectations of a removal of petrol subsidies. Let's take a listen.
MPC observed the continued upward risks to price development around expectations on the removal of the PMS subsidy, rising prices of other energy sources, continued exchange rate pressure, and uncertain climatic conditions. These, in the view of members, provides a compelling argument for an upward adjustment of policy rate, albeit less aggressively. Committee, however, noted that the Naira redesign and cash withdrawal limit policies have resulted in a sizable reduction in currency outside the bank, indicating expected improvement in the potency of monetary policy tools. Members, however, remained aware of the ongoing challenges associated with the limits imposed on cash withdrawals in the face of frequent downtime in bank electronic transaction channels. Committee thus called on the other depository corporations, online payment platforms, and other stakeholders to ensure that the prevailing incidence of network failures is overcome in the immediate and short term. This would ensure that the Naira redesign and cash withdrawal policies lead to an improved inroad of the CBN cashless policy program and efficiency of the transmission mechanism of monetary policy. Members thus resolved by a majority vote to raise the monetary policy rate MPR by 50 basis points. In summary, 10 members voted to raise MPR by 50 basis points, 1 member voted to raise MPR by 25 basis points, and 1 member voted to hold the MPR. All members voted to keep all other parameters constant. The MPC therefore voted as follows. 1. Raise the MPR to 18%. 2. Retain the asymmetric corridor at plus 100 and minus 500 basis points around the MPR. 3. Retain the CRR at 32.5%. And 4. Retain liquidity ratio at 30%.
All right, joining us to discuss Chinwe Egwem. She's the chief economist at Coronation Merchant Bank. And in the building with us here, Joshua Odebisi, who of course is a senior research analyst at Rand Merchant Bank Nigeria. Good afternoon to you both. Thank you for joining us. So Chinwe, let's start with you. Quick answers from the both of you. Was this part of your forecast?
Yeah, Brutus, thanks for having me. Yes, we had projected a 50 basis points policy rate hike with other parameters left unchanged, and this was very well articulated in recent publications that we released from Coronation.
Joshua, what about you? Was this part of your hike?
Yeah, this was completely in line with our expectations, although it was just a slight surprise that so many voted to hike by 50 basis points. We thought that there'd be a bit more of a spread and a few more members voting to hold, but in general, we expected this hike.
All right, so now let's quickly get to the impact. Chinwe, who feels this? Who feels this hike?
The 50 basis points increase in the policy rate is likely to lead to increased borrowing costs. Yields on fixed income instruments are also likely to stay at current levels. But I must highlight that the scheduled coupon payments and a bond maturity in April will support liquidity and also impact yield movement. Okay.
Joshua, you agree?
Yeah, absolutely. I think that at this point, a 50 bips hike, when we've already started to see a little bit of a deceleration in inflation, means that we'll probably see further decelerations, at least leading up until the deregulation of the downstream sector.
Yeah, we're gonna get to that. Inflation, okay, as Joshua has mentioned, Chinwe and Joshua, look, year-on-year inflation, that increased 21.9, but month-on-month we did see a deceleration, which the central bank governor mentioned. Joshua just mentioned that as well. Now, I'm going back to the cash redesign and the scarcity of cash. The expectation was that cash scarcity would have an impact on the demand for goods and services. So can we effectively say that was reflected in the month-on-month inflation figures, Chinwe?
Well, let me just say that the month-on-month declines could be partly attributed to the rate hike seen in the past months. Last year, the policy rate was hiked by about 500 basis points. And then this year, we've seen it hiked or raised by 150 basis points, right? However, we did expect to see the impact of one, the flooding crisis, which happened in the final quarter of last year, and then the impact of the cash scarcity triggered by the implementation of the Naira redesign policy. We expected to see higher month-on-month rates in the past few inflation report releases. So I actually do suspect that there will be a lagged effect, and we expect to see month-on-month inflation at or above 1.6%.
Thanks for that. So, Joshua, I thought year-on-year would actually decelerate. I thought we'll see both a deceleration year-on-year and month-on-month. So, is this, again, for the cash scarcity, does the month-on-month actually validate the impact of that?
Well, I think that it's a bit of a net effect,
okay,
simply because of the fact that at the same time as there's less cash in the system, that cash became way more expensive, in quotes, because the cost of withdrawal went up significantly. Well, of course, that would have had an impact on people's spending power as well. So when you look at it from that perspective, you would say that, on the one hand, less cash, more migration onto digital platforms, digital channels, and digital transactions may have, in effect, lessened inflation, but at the same time, the cash that was out in the system became more expensive.
Yeah. Okay, so still on inflation, and I want to get to something that the governor said while he was talking about inflation. He particularly mentioned food inflation, and he made some observations on the continued increase in food inflation here in the country. And he made three observations in his briefing to the press. He said that, one, if we bring up the challenges for our viewers, the challenges of the food supply shocks. Okay, there it is. So he said increase in road transportation costs, security issues in food producing areas, and legacy infrastructure challenges. Chinwe, starting with you, and Joshua, same question. Are these clearly not out of the, or not, are these clearly out of the scope of the MPC? And is it not a fiscal issue with respect to trying to get food inflation down, Chinwe?
Well, okay, so through our intelligence reports and publications, we have reiterated several times that fiscal and monetary policy cohesiveness is imperative. Now, supply side shocks, which visibly impacts cost push inflation, as seen with sticky food prices, as you've just mentioned, should be tackled from the fiscal side. So yes, you're correct. However, there are interlinkages. The NPR is used as a tool to tame inflation. And so the MPC making observations around infrastructure gaps or structural issues is expected.
Okay, Joshua, because I mean, if the Monetary Policy Committee is telling us that there are things that are outside their purview that are impacting the very thing that the rate hike is supposed to tame, and it's not taming it, is there any subliminal message there? What are they? I mean, but so again, what do you make of the observations on food?
Well, I mean, to be fair, I think that's at least being very honest about the fact that, unfortunately, we're using monetary policy to, in my opinion, solve fiscal challenges, right? Obviously, when he talks about legacy infrastructure challenges, those are the things that are putting a bit of a limiter on how much the MPC can actually do to lessen inflation. Because even if we didn't have any of these other challenges, even if food production was still good and we didn't have security challenges, those infrastructure challenges would be a limiter on how much food prices could reduce.
Right.
So ultimately, how far do you expect the MPC or the NPR to go to lessen inflation? I think they could go as high as 25%, and it would still have a limiting effect on inflation.
Oh, well, so is it effective? Is Chinwe, I'll come to you. So is the continued hiking, if inflation keeps rising, is it getting us anywhere?
So the thing is that they have to do what is within their power to try and solve the problem, right? Then hope for, like Chinwe said, cohesiveness between their monetary policy and the government's fiscal policy. So they can only do that. They're doing their part, so it's time for the government to do theirs.
So Chinwe, on that point, is that it? They're just going to just do what's within their power and just hope that the other side does what it's doing? Because the numbers do not lie. It continues to rise despite now cumulatively 600 basis points now, or 550 from last year to now. So is that it? They just keep doing what they can?
Yeah, because it's not so you're tackling not just cost push inflation. You're tackling not just demand pull inflation, but also cost push inflation. So yeah, the cohesiveness is required, as I said.
All right, what about, let's look externally, because when the governor started his speech, he talked about the global issues. How much pressure is being heaped on emerging markets from the likes of Jerome Powell at the Fed, Christine Lagarde at the ECB, Andrew Bailey over in the Bank of England? How much pressure are they getting from the rate hikes that are coming from these folks?
The thing is that we still expect the international capital market to remain expensive for emerging markets this year, Nigeria inclusive. There are still concerns around debt service costs and debt sustainability risks for emerging economies with significant dollar-denominated liabilities remaining high. I do not think that the tightening posture seen in advanced economies will end in the near term, given inflation levels seen in the US and the Eurozone and also in the United Kingdom. However, there are speculations that the US Federal Open Market Committee may hike at a slower pace at their next meeting, which I believe is scheduled to hold today and tomorrow.
Joshua, what do you think? Because the impact on what these folks out there out in the West are having on emerging markets such as us.
Well, in terms of generally the Nigerian market, due to the fact that from about 2020 to even last year, we saw quite a lot of capital flight. In fact, before last year, I think that a lot of these internationals had already left the market and gone back to their home countries or to other markets that were a little bit easier to exit out of. I think that any rate hikes you see in the developed market or in the developed world would have a smaller impact on Nigeria or smaller pressure on Nigeria simply because investors are not weighing up that option at the moment. Nigeria is just simply not an option for those foreign currency FPIs back into the country until we fix a lot of our issues with liquidity. And so even increasing our own interest rates in lockstep with them, even if they become less aggressive due to the kind of issues that they're seeing with their banking system because of their aggressive rate hikes, even if they do slow down, it would still not drive investors back to us.
Okay, so what about our neighbors? What about the Dr. Ernest Addison in Ghana? Chinwe, let me come back to you. Lesotho Kanyego in South Africa, Mr. Koroje in Kenya, and so on. For the other emerging markets, what do they do for the foreseeable future?
Well, let me say that inflation levels in each of the countries you listed remain elevated, and that is relative to their respective inflation targets. The posture has been that of combating rising inflation, as seen in other countries, and to an extent, considering the policy stance of select advanced economies. Now, committee members typically examine economic data such as GDP, inflation, employment figures, purchasing managers index, and consumer confidence index for countries that have these before making decisions around any policy rate hike. Now, Ghana's inflation moderated in January and February, but it's still high. So another rate hike is not far-fetched. For Kenya, I also think that they may consider raising rates in the near term, given their inflation direction, which went up by about 20 basis points in February.
Joshua, what do you think? Because, I read that the shilling, particularly in Kenya, has been taking a beating because of rate hikes over in the West. But, for regionally, how do you see what our neighbors are going to be doing?
Well, I think that at some point they're going to have to start considering the impact that constant rate hikes will have on growth, simply because, obviously, there is a bit of a balancing act you have to play between the rising inflation and growth. And so if you're trying to control inflation by raising rates, you might have an impact on general economic growth. Now, we may have not gotten to that point simply because of the constant inflation increases, but at some point that's going to have to become a consideration. I think this year, probably towards the end of the year, they would start to sort of take stock of their rate hikes and the impact it has had on the economy and on inflation, and try and see if they have to make a balance.
You know, I don't know. The theme seems to be that the monetary policy, its impact seems to be shrinking from the fiscal side, and then what's happening externally. It just seems like what they can do, the impact just continues to fall. But let's get to growth, since Joshua just mentioned growth, particularly for Nigeria. The GDP projections for 2023. I think the CBN governor read some of them. The federal government, I think, if I heard him correctly, 3.2%. That's the federal government of Nigeria as far as their projections coming out from the Ministry of Finance. CBN at 3.03, IMF at 3.2. Chinwe, what do you make of these forecasts? What's yours? We could spend an hour here on Nigeria's economy and what we expect. So what do you think? In line, by the way, well, Chinwe, wait, hold on. In line with the fact that we could still see a continued rise in inflation and a continued hike in rates. How do you contextualize all that along with these projections? Yeah, go ahead.
Okay, in our base case scenario, we see GDP growth at 2.8% for 2023, or at the end of 2023. And what did we do? We considered stable oil prices above $75 per barrel. We also expect domestic crude oil production to remain below pre-COVID-19 levels due to existing challenges within the sector. We also did take into consideration the relatively weak consumption patterns on the back of high inflation and its impact on service-oriented sectors. The impact of FX depreciation and increased borrowing costs on business activities was also considered. And finally, we did consider that in the first half of this year, economic growth figures will be impacted by the current cash scarcity, which has been triggered by the Naira redesign policy. So 2.8% year on year, that's our current figure.
All right, so you're more conservative than the government's central bank and the IMF. And yes, I honestly cannot wait to see those first quarter GDP figures for this year, considering even with the elections shutting down activity. Joshua, what do you folks at Rand Mention Bank, how are you seeing things this year for GDP growth? What do you make of those projections? Are they?
Well, what I would say is, if we take the CBN and the federal government at their word when they say that they're going to remove subsidies and deregulate the downstream sector by the second half of the year, then we can just do a little bit of a rough calculation. Currently, landing costs are at about 237 last I checked. Now, between that, transportation costs and the marketer's own markup, you're probably going to see petrol costs almost double by the time, if current conditions hold true until then, then conservatively speaking, I'd say that's even a bit bullish. But at that point, transportation costs across the country are going to go up. Inflation is going to probably skyrocket on the back of that. And then coupled with cash scarcity, hopefully this is not the case up until then, but if it is the case, then all those things will start to have an impact. And so I think that maybe that 3% to that 3.2 is a little bit bullish on the back of all these things and many, many more things that you could also consider.
You know, when you consider the fact that, again, on the food supply shocks from that this MPC observed, that number one is transportation costs, and you've got 95, 96, 97% of goods that move in this country by road. What removing fuel subsidy? Anyway, let's jump into the fuel subsidy since Joshua has mentioned it. Chinwe, do you think that fuel subsidies will be removed? Because the governor said he expects that to happen by the end of June. And what's are you in line with what Joshua is saying as far as the impact on inflation, prices, and so on will be?
Yeah, we do expect fuel subsidy removal, but from our vantage point, we believe that it will be phased out as opposed to all at once. And with regards to our inflation outlook, we do expect inflation to moderate, not really on the back of the PMS removal, but also because there are other factors to consider, namely positive base effects. So we expect inflation to moderate, but it will still remain high at double-digit levels. Consumer pockets will remain squeezed, and so demand patterns are unlikely to be significantly different from what we saw in 2022. So for our base case right now, our inflation forecast is about 18.3% for the end of the year.
Oh, wow. Okay. Wait, so Joshua, let me come back to that. Thanks, Chinwe. this whole matter of whether it would be fuel subsidies will be yanked or removed in phases. The language that I got from our president-elect, I mean, assuming all the court cases are set aside, but, you know, Bola Ahmed Tinubu is, of course, president-elect, and, you know, he's the one expected to be sworn in, decide all the legal stuff. He sounded like he was going to yank it. That's how he sounded. Now, is there, I mean, Chinwe is expecting it to be phased, and this is a lot of debate. So the analysts, some are saying phase, withdrawal, some are saying yank. Does that play into the impact on prices? It should, right? Depending on whether it's yanked. And but what do you think? Is it going to be yanked or is it going to be phased out?
Well, just speaking from a practical perspective, if they decide to phase it out, that could create a situation where there is artificial scarcity, simply due to the fact that the marketers will expect that the price will go up, you know, if it's going to go up month on month or however many days at a time.
Yeah.
There will be artificial scarcity because they know that the longer they hold on to the subsidized fuel that they already have, the higher the price they will be able to sell it later on. So a phasing out would create its own challenges and its own issues, while a yanking obviously would create a pretty big shock on the economy all at once. Right. So it's just a matter of picking your poison.
Oh boy, I really cannot wait for the swearing in, and then the clock starts ticking. Chinwe, what about the impact on the everyday Nigerian on the streets? How is all this MPC rate hikes, inflation, 2% GDP growth projections versus 3% or 3.2? What about our brothers and sisters out there? What about them?
Well, let me tackle that from an SME perspective. I would say that in a high inflation environment, innovative marketing where products take into consideration the different customers under a portfolio remains important, given that consumption patterns continue to point towards decisions around competing priorities. And that is not surprising because purchasing power is receiving a lot of pressure right now. Now, from the supply side perspective, global commodity prices are expected to stay elevated, which impacts imported input. We also expect transmission effect of high energy prices to continue to impact operational costs and continuous upward pressure on CapEx and operating expenses this year. So a cost management posture should continue to be adopted. And also SMEs should consider seeking investment opportunities that can generate additional income.
You know, I wish I could play our exclusive interview with the governor of Delta State, current governor, outgoing governor, where he was talking about the rising interest rates and how it's impacting SMEs. But Joshua, you get the last word. We only got a minute to go. The average Nigerian, how are they going to cope with all this?
Well, unfortunately, I think that the average Nigerian is extremely resilient because of all the economic shocks that they have been through in such a short period of time. So they will continue to persevere and persist. But I think that we cannot take much more of this economic hardship, and things becoming more expensive on an almost daily basis is not sustainable, and we need a new direction.
Well, it's a fascinating year ahead. Joshua Adebisi, Senior Research Analyst, Rand Merchant Bank Nigeria. Chinwe Egwim, Chief Economist at Coronation Merchant Bank. Thank you both for joining us to give us the lay of the economic land with respect to what it means with this latest rate hike and what it means for the average Nigerian and business industry. You too, thank you so much. Really appreciate your time.